Well, hello dragons, and welcome to this instructional video for Lesson 13, Part 3, Stocks, Bonds, and Futures. The main idea behind this economics lesson is stocks, bonds, and futures are collectively referred to as securities. With that in mind, by the end of watching this video, you will be able to explain why and how people invest in stocks, describe what factors influences stock prices, differentiate between corporate bonds, government bonds, and stocks, and identify the advantages and disadvantages of futures. Now that the outcomes for this lesson have been shared with you, let's get started. Saving and investing require you to make decisions about how to use your money. If you decide to invest your money, further choices arise. For example, do you want to own part of a corporation by becoming a shareholder, or simply lend money by becoming a bondholder? Are you most concerned about low risk or high return? As you watch this video, think about the factors that contribute to financial decisions. Stock prices rise. Experts predict market downturn. You may have seen newspaper headlines like these. Sometimes stocks can seem like an uncertain investment with random price changes. Why then do people buy stocks? There are three main reasons that people choose to invest in stocks. People often hope to gain a profit, limit the risk on their investment, and become a part owner of a corporation. Stocks can provide a profit in two ways. First, many stockholders receive regular dividends on the money invested in stocks. As noted in Lesson 2, dividends are paid to a shareholder in return for an investment. Most corporations pay dividends quarterly, while others pay them annually or semi-annually. Stocks that pay consistent dividends are called income stocks. These stocks provide a steady amount of current income to investors. Stocks that pay few or no dividends, but that increase in value, are called growth stocks. Investors generally purchase growth stocks in order to increase the value of their assets. A second way to earn profit on a stock is to sell it at a higher price than the original purchase price. The difference between the higher selling price and the lower original price is the investor's capital gain. An investor who sells a stock at a price lower than the purchase price, however, incurs a capital loss. Stockholders are protected from some risks. Unlike sole proprietors and partners, stockholders and corporations enjoy limited liability. As noted in Lesson 2, the amount of money a stockholder can lose is limited to the amount he or she invested in the stock. People also invest in stocks to become owners in a corporation and to vote on company matters. The number of votes a shareholder has is equal to the number of shares of stock he or she owns. As owners, shareholders vote to elect the board of directors, as well as to decide a variety of other business issues. One such issue involves when to initiate a stock split. Suppose that the directors of Gadsden Publications determine that the price of Gadsden's stock has become so high that it discourages potential investors from purchasing shares. The directors may decide to split each share into two. After the shareholders approve the 2-for-1 stock split, a shareholder will have 2 shares of Gadsden stock for every single share held before the split. The price is divided along with the stock, so that stock previously selling for $100 will sell for $50 after the split. Shareholders generally like stock splits because share prices tend to rise afterward. Suppose that Brad wants to buy stock. Does he call a corporation and place a purchase order? Probably not. Very few corporations sell stock directly. Instead, Brad contacts a company that specializes in selling stocks. These companies belong to a network of brokerage firms, investment banks, and stock exchanges. Stockbrokers, often called brokers, link buyers and sellers of stock. Brokers work for brokerage firms, which are businesses that specialize in trading stocks and other securities. Brokers and brokerage firms earn a profit by collecting a commission or fee on each transaction. Corporations usually do not issue new stock or trade large blocks of other stocks without help. They usually contact an investment bank, which buys and sells large blocks of stock. Investment banks usually buy the stock when offered by a company and then offer that stock to the general public. Like brokers, investment banks collect commissions on transactions. When people speak of the stock market, they generally are referring to the New York Stock Exchange, or the NYSE. The NYSE, the largest stock exchange in the United States, began informal operations in 1792 on Wall Street in New York City, providing a place to buy and sell corporate stocks and government bonds. Before the Civil War, other brokers founded the New York Curb Agency, a name that arose because brokers actually met on the street. In 1953, the name was officially changed to the American Stock Market, or Amex. Besides the NYSE and the Amex, 5 regional stock exchanges are located in other U.S. cities. Major world cities such as Tokyo, Hong Kong, London, Frankfurt, and Paris also have stock exchanges on which some U.S. firms are able to trade. Around 2,600 companies that now have their shares traded on the NYSE and Amex must meet rigorous standards concerning number of shareholders, number of shares, and minimum earnings. Companies on the NYSE and Amex must also follow standard accounting practices in calculating their earnings. Stocks that are not listed on the NYSE or other stock exchanges are traded on the over-the-counter or OTC market. Many smaller corporations that do not meet the standards set by the nation's stock exchanges can still trade their stocks OTC. These stocks are sometimes called OTC stocks. Investors still need brokers to trade OTC stocks. First, buyers and sellers place buy or sell orders with their brokers. Second, the brokers arrange the purchase or sale by using a market service called NASDAQ, formerly known as the National Association of Securities Dealers Automated Quotations, which lists thousands of stocks not listed on the stock exchanges. To arrange for the sale or purchase of stocks not listed on NASDAQ, the brokers contact other brokers who have clients interested in trading the stock. Suppose that you decide to invest in a company's stock. How can you find out the price? If you look in the business section of the local newspaper, you may find a list of stock prices. The numbers you see represent dollars and cents. For example, a stock listed at 38.12 means that the price for one share of stock is $38.12. Shares usually are traded in lots, or amounts of 100. Smaller amounts are referred to as odd lots. The stockbroker's task is to make a sale by reconciling a bid price with an asked price. For example, a buyer bids $37.30 a share, and the seller asks $38.12. If the stockbroker persuades the buyer to pay 50 cents more for a share and the seller to sell for 25 cents less, a sale is made at $37.87. When many buyers compete for a scarce supply of stock, demand pushes up the price. Similarly, when there is a large supply of stock and few buyers, low demand pushes down the price. In this way, demand affects stock prices. The main factors influencing demand for a stock are corporate finances, investor expectations, and external forces. A corporation's financial strength usually is measured in terms of profits and losses. A company's quarterly and annual earnings reports are read carefully by investors, market analysts, and brokers. When confident that a corporation produces high-quality products and has good long-term prospects, investors will buy its stock. Such stocks are called blue-chip stocks and are in high demand during both upswings and downswings of the stock market because of their long-term stability and value. Apple, Coca-Cola, Microsoft, and Walt Disney are examples of corporations with blue-chip stocks. As noted in Lesson 3, consumer expectations can influence demand. Similarly, investors' expectations about the future prices of a stock can affect the stock's current market price. Investors increase their demand for a stock and buy it when they expect it to increase in value and tend to decrease their demand or sell it when they believe a stock's value will decrease. Investors, market analysts, and brokers form their expectations in part by watching the fluctuations in stock indexes, such as the Dow Jones Industrial Average, or the Dow. The Dow records changes in the stock prices of a select group of 30 major industrial companies. When the Dow steadily rises over a period of time, a bull market is said to exist. When the Dow average falls for a period of time, on the other hand, a bear market is said to exist. In a bull market, investors expect an increase in profits and thus buy stock. During a bear market, however, investors sell their stock in the expectations of reduced profit. These markets are named after the way each of these animals defends itself. A bull will buck up with its horns, and a bear will swat down with its paws. Sometimes forces over which neither the stock market nor private firms have any control influence the price of stock. For example, the price of Johnson & Johnson stock fell in 1982 after someone put poison in a few bottles of Tylenol capsules in the Chicago area. Johnson & Johnson voluntarily withdrew all Tylenol capsules from store shelves. Some investors feared that Johnson & Johnson's profits would fall. These investors rushed to sell their Johnson & Johnson shares, contributing to a drop in the stock's price. This drop was temporary, however. After Johnson & Johnson introduced new forms of Tylenol that were more difficult to tamper with, public confidence increased and the stock's price rose again. Other external forces include government statistics on unemployment, inflation, interest rates, and the number of new houses being built. National and international events such as revolutions, assassinations of world leaders, and elections can affect investor confidence. For example, when Mexican President Luis Donaldo Colosio Murrieta was assassinated in 1994, prices on the Mexican stock exchange plunged as investors sold large amounts of stocks. Prices recovered quickly, however, in part because the Mexican and U.S. governments worked together to avoid an economic slowdown that might have harmed both nations. Corporate bonds and government bonds are other forms of investment. Although bond yields, or interest on money owed to a bondholder, are frequently lower than stock dividends, they generally offer less risk. Additionally, if a company goes out of business, bondholders must be paid before stockholders. As noted in Lesson 2, corporations sell bonds to raise large sums of money that might be difficult to obtain from a bank. Corporate bonds come in large units, such as $1,000, $5,000, or $10,000 each. The investor purchases a bond at face value, the value listed on the bond when issued, and receives an annual interest payment. On the maturity date, the investor collects the final interest payment and the principal, or the amount of the original bond. Brokerage firms sell the corporate bonds to the public over the counter or on the NYSE and Amex bond markets. Corporate bonds are similar to government bonds that represent debt that the government must repay the investor. The U.S. government, specifically the Treasury Department, issues not only Treasury bonds, but also Treasury bills and notes. These three investments offer different lengths of maturity and require different minimum investments. They all carry fixed interest rates and are redeemable at stated maturity dates, which vary in length from 90 days to 30 years past the date of purchase. In contrast to corporate bonds, whose interest is taxed as normal income, bonds issued by the federal government pay interest that is exempt from state and local taxes, but not from federal income taxes. Backed by the full faith and credit of the federal government, these Treasury bonds, bills, and notes are among the safest of all investments. State, county, and local governments and municipalities, such as water districts, also issue bonds. For the most part, these bonds have been safe investments since the Great Depression, but they do carry an element of risk. For example, for 18 months beginning in late 1994, people were uncertain whether they would be able to redeem municipal bonds they had purchased from Orange County, California. Orange County was in severe financial difficulty as a result of risky investments by Orange County officials. Not until June 1996 did the municipal bonds become redeemable.
We are here to try to explain to you what it is we do here.
We are commodities brokers, William. Now, what are commodities? Commodities are agricultural products, like coffee that you had for breakfast, wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich. And then there are other commodities like frozen orange juice and gold. Though, of course, gold doesn't grow on trees like oranges. Clear so far?
Yeah.
Good, William. Now, some of our clients are speculating that the price of gold will rise in the future, and we have other clients who are speculating that the price of gold is going to fall. They place their orders with us, and we buy or sell their gold for them.
Tell them the good part.
The good part, William, is that no matter whether our clients make money or lose money, Duke and Duke get the commissions.
Well, what do you think, Valentine?
Well, it sounds to me like you guys are a couple of bookies.
I told you he'd understand.
Futures are another type of investment. In futures markets, such as the Chicago Board of Trade, instead of trading stock, investors trade various types of products called futures. As you saw in the clip, futures include agricultural products such as corn, wheat, soybeans, and oats. They also include industrial goods such as steel and coal, and precious metals and gemstones such as gold, silver, and diamonds. Because futures trading carries a high risk, investors must have specialized knowledge about the commodities being bought and sold. How does futures trading work? When traders sell futures, they accept an investor's money today in exchange for a promise to deliver a commodity to the investor at a later date. The terms of a futures trade are stated in a contract. For example, suppose that Joanne decides to invest in hog futures. She signs a contract in which she agrees to pay a certain amount of money for a later delivery of hogs, perhaps 6 months after the purchase. Joanne probably does not want to own the hogs, however. She is hoping that the price of hogs will increase within the 6-month period so she can resell the contract and make a profit. How can the futures market benefit Joanne? If the market price of hogs rises over the price listed on the contract, the hog owner must still honor the contract and deliver the hogs to Joanne at the lower than market price that it lists. Joanne can resell the hog contract at the current market price and make a profit. The hog owner, on the other hand, hopes that the price will drop within the contract's 6-month period. Why? If the market price of hogs drops below the price that Joanne paid in the contract, the hog owner has made a greater profit than is available at the current market price. If the owner has not sold the hogs in advance, he or she would have received the later, lower market price for the hogs. Both Joanne and the hog owner face tremendous risks. The buyer and the seller essentially are betting that the price of hogs will reach a certain level by a particular time. Depending on whether the price rises or falls, either the seller or the buyer could lose a great deal of money. This is why Valentine refers to the Duke brothers as bookies, because they are gambling on the future price of commodities. Throughout the 1800s, trade in securities was not monitored by any organizations outside the stock exchanges. As a result, dishonest securities dealers often provided investors with misleading or false information. During the early 1900s, Congress passed several acts to regulate trading in securities. As noted in Lesson 5, the Clayton Antitrust Act in 1914 outlawed many monopolistic practices. The act discouraged the formation of monopolies by forbidding corporations from buying stock in competing companies when doing so could result in monopolistic control over an industry. The next key piece of legislation came in 1933. The Federal Securities Act, also called the Truth in Securities Act, requires all companies to register their securities with the Federal Trade Commission, or the FTC. Just a year later, the Securities Exchange Act established the Securities and Exchange Commission, or the SEC, to enforce the Federal Securities Act. Companies must meet rigorous standards to sell their stock in a stock exchange. Additionally, companies register their securities by providing a detailed financial statement to the SEC and a prospectus to potential investors. A prospectus is a fact sheet containing data on the company's finances. Investors use the prospectus to evaluate securities that are offered for sale. The SEC is empowered to charge heavy fines for violations of these requirements. The SEC also regulates the procedures for the trading of securities. The SEC licenses all stock exchanges in the United States and regulates the activities of brokers and brokerage houses to guard against fraud and other unethical actions. So that's the way it is with Lesson 13, Part 3, Stocks, Bonds, and Futures. At this point, you should know that investors use brokers to purchase stocks in order to earn a profit, limit risk, and make decisions for a corporation. Corporate finances, investor expectations, and external forces influence stock prices. Bonds represent debt that must be repaid to investors, either by a corporation or the government, and stocks represent ownership in a corporation, and futures can be highly profitable but are very risky investments. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons.